Good morning. This is Professor Menton, and I'm going to do this video in several parts because there's a lot to this. And what I'm talking about, of course, is the serial problem for Chapter 3, and then ultimately the serial problem for Chapter 4 that closes the books out. And so, because there are so many component parts to this, I think it's just better for me to break it down into smaller components. So the first thing I want to point your attention to is this is the trial balance that we ended up with at the end of chapter 2. And we had cash of a certain amount and accounts receivable and so forth. And we came down to a total, as you'll recall, of $98,659. And the way that we got there is we had all of these entries from October and November that we posted to each one of these ledger accounts over here uh, that are reflected by T accounts that I've created here in Excel. And so once we had all of those posted, then we added them up. And if it was a normal debit balance account, like cash is a normal debit balance account, it's an asset. All assets go up on the left-hand side and go down on the right-hand side. So anything that represented an income of cash, okay, or an input of cash coming in, then we posted that to the left-hand side. And anything that represented cash going out, we posted it to the right-hand side. And that's all that debit and credit means, left and right, respectively. And the same thing is true for accounts receivable. As we perform services for people, and didn't get paid, we put that on the left-hand side to indicate that accounts receivable was going up. And when they paid us for it, as they did over here, we reflected that by putting something on the right-hand side of the account. Now, in the real world, we would have an account for every single one of our customers so that we don't get them confused. In this particular world, because we're doing it for the first time, we're not going to talk about subsidiary ledgers yet, but bear in mind that we would always want to make sure that we knew exactly who it was that owed us money, just as we'd want to make sure who we owed money to. So anyway, we did that. We posted to all of the accounts. And so just as an example, we posted $2,220 to prepaid insurance. And we didn't have any changes to that. So if you come over here, you see prepaid insurance of 2220. And when we had done that with all of our accounts, we came up with this $98,659. Now let's take a quick look at the requirements for the month of December. And so in this particular case, they've given us a new trial balance. And notice that the trial balance still comes out to $98,659. However, you'll now notice that what they've added are several zero balance accounts, accumulated depreciation, wages payable. Now, accounts payable, we had something that went into it in November, I believe, and came right back out of it. In other words, we incurred a debt and we paid the debt, so the balance came back to zero. We didn't have any wages payable because we didn't what we call accrue for those at the end of November. We're waiting until the end of December to do all of our accruing. And accruing simply means that if we have incurred a liability or an expense, or if we have done a service that has not yet been billed, then at this point, at the end of a period, like a December 31st period, the end of a quarter, and when we report out our financial statements, we want to make sure that everything is up to date. So we're going to go and make adjustments for all of these things. We have another 200 level account, and remember that all 100 level accounts are assets, all 200 level accounts are liabilities, 300s are the capital accounts, 400s are the revenue accounts, and then 5, 6, 7, and 800s are your expense accounts. In this case, we've only used the 600 accounts. But when you get into a manufacturing business, it can become much more complex. Okay, so let's go back over here to our trial balance and our ledger. And now let's take a look at the entries that they want us to do. And I guess I could flop back over to this thing for a second. Uh, Business Solutions had the following transactions and events for December of 2019. And here they gave us a number of different entries that we need to make, or actually transactions that we need to make entries for. And so what I'm going to do is I'm going to walk you down how we made each one of those entries. And so I've already done them to keep the video down to a reasonable size. Um, and let's see here if I can find that's the trial balance. Oh, here's the December. Okay, so here's where I made the actual entries for the general journal for the month of December. And so let's go back over to the requirements, and I'll explain to you how and why we made each one of these entries. So we paid $1,025 cash to Hillside Mall for Business Solutions' share of mall advertising costs. And so what happens is the mall itself will advertise so that people come to the mall in general and then go to various stores within the mall. And the stores that are in the mall will be asked to contribute to the advertising that goes into actually getting people into the mall itself. So in this case, we've paid $1,025 cash to the Hillside Mall for mall advertising costs. And so if we go back over here, this is the entry that you would make. We're going to debit the expense, and expenses go up on the left. They reduce capital. Remember, capital is on the or equity, I should say, is on the right-hand side of the basic accounting equation. Assets equals liabilities plus equity. And the expenses are part of the equity section, but they go up on the left so that we can track them, keep track of how much we're spending at each one of these areas, but they actually serve to reduce equity. So all expenses bring equity in our business down. And the other side of this is going to be cash. Now, typically we would go out and post this right now. Instead, what I'm going to do is I'm just going to go in the next video, I will already have those posted so that we can look now at a new trial balance based upon um, these entries that we're making here before any adjustments, because the name of the chapter for chapter 3 is how we do adjustments. I'm just going ahead and doing this so that you have kind of a refresher of chapters 1 and 2. Okay, the next thing they tell us, he paid $500 cash for minor repairs to the company's computer. Okay, well, here's the company's computer, and we did $500 worth of expenses. It's the same kind of a deal as we have up here. It's just a different classification of expenses, but it's still expenses. They still reduce equity, and we still want to track them so we know exactly how much we've spent during the course of a period of time. May that be a month or a quarter or a year, how much we have spent on those particular repairs. So in this case, we're going to debit repairs expense and we'll credit cash. Remember, cash is an asset. It goes up on the left-hand side, and it's part, when you look at the basic accounting equation, assets is equal to liabilities plus owner's equity, or equity. What you get is the assets sitting on the left-hand side by themselves. Now they go up on the left, they go down on the right. So this represents an outflow of cash. So we're going to credit the cash here to reflect that. Okay, the next entry. Received $3,950 cash from Alex Engineering for the receivable from November. And maybe it's a good idea to take a quick look over here at that receivable account. And you see this is the $3,950 that they're referring to. So we did some work for them. They didn't pay us at that time, and now they are going to pay us. So the next time you look at this, you'll see a credit here for $3,950 to make this number actually go away. All right. And so let me go back over to the entry itself so you can see the entry. Well, shoot, where did I put it? Let's go back over to the December entries here. Here we go. And so you see we're going to get cash in. So that cash as an asset's going up. So we're going to put it on the left-hand side. And accounts receivable is also an asset. And it's going down on the right-hand side. Notice what I did in this particular case is I added the words or the name Alex Engineering to it because I want you to understand that eventually when we get a little bit further down the line, every time we look at a company paying us or charging something to us or whatever, we're always going to recognize their name. Otherwise, we lose track of who owes us what and what we and to whom we owe money. So we have to do it that way. All right. So the next one. Um, Paid cash to Lynn Addy for 6 days of work at the rate of $125 a day. So if we look at that, if we take $125 per day times six, and by the way, this is about as tough as the math gets in this class. 6 times 125 will give us $750. Now those represent wages expenses, and we're going to pay her cash. So cash is going down. That's reflected by the fact that it's on the right-hand side. Now, this expense for wages is handled the same way this expense was handled and this expense. It's just a change in the kind of expense that we're going through here. All right, next one. This one's this one I need to take a little bit of time on because this one is something completely different. You haven't seen this before. Notified by Alex Engineering Company, the business solutions bid of $7,000 on a proposed project has been accepted. So what happened is Alex Engineering put out a request for bids on a project that they want done for their computer department. And so Business Solutions bid on that project and they bid $7,000 and that was the bid that was accepted. To get them started, Alex paid him $1,500 in cash up front. Now, since Business Solutions hasn't done any work yet for Alex Engineering, they cannot recognize any revenue. You only get to recognize revenue once you've substantially completed the service. At this point, they haven't done anything. So if something happened and they said, you know what, we thought it over, we really can't handle this job or whatever the case might be. Maybe their company burned down or somebody, S-ray died or something, whatever the case might be, they would have to refund the $1,500 cash. So at this point, it's not a revenue. At this point, it is a liability. And so if you come back over here and look, and if we were actually to look at the new chart of accounts that we've established, and I've got it right here actually, you will see that I have here a 236 number. Now, 200 numbers are always liabilities, and this is unearned computer services revenue. It gets confusing for students because we use the word revenue and they think, well, that's a revenue. No, this is a liability and it will remain a liability until we perform the service. Okay, so in order to record this, you have the cash coming in of 1,500 and a reflection of the fact that we still have not performed any services, so we have a liability that we're setting up here, unearned services revenue. Okay, the next one. On the 15th, we purchased $1,100 of computer supplies on credit from Harris Office Products. Now, this is the third or fourth time that we have purchased computer supplies from Harris Office Products. So if you think about it, those supplies, the asset, computer supplies, is building up, even though we've used a bunch of those up. So we'll get into when we do the adjustments, we're going to adjust that account to its proper value. But for right now, what we're going to do is just make the recording of this entry. So we're going to debit computer supplies, the asset. Assets go up on the left and down on the right. And we're going to credit, because they're going up here, we're going to credit accounts payable. Accounts payable is on the liability side of the basic accounting equation. Assets is equal to liabilities plus equity. And those things on the right-hand side of that equation go up on the right and down on the left. In this case, we're incurring a new debt, so it's going up. So we'll make computer supplies debit of 1,100 and accounts payable credit of that same amount. Okay, the next thing that happened, sent a reminder to Gomez Company to pay the fee for services recorded on November the 8th. Well, that's fine, but that's not an economic event. That's just a reminder. We've already recorded the economic event. Now all we're doing is waiting for Gomez to pay us. On the 20th, completed a project for Lee Construction Corporation, I'm sorry, and received $56.25 in cash. So what we did was we went out and we did some work for this company, and they paid us in cash. So if we pop back over here, you see the cash going up. It does on the left-hand side. And we actually did perform the services here. So it's proper for us to recognize that we have a revenue stream coming in. Revenue is part of equity. It's a part of equity that makes equity go up. Expenses make it come down, equity make it go up. So it's going up on the right-hand side here. Okay, the 22nd, 26th took a week off for the holidays. Well, that's wonderful. I'm glad to hear they got some time off. If it doesn't affect us because it's not an economic event, and they're telling us some things in here to see whether or not we're going to try to do something with those when we shouldn't. And in this case, there's nothing to do here. We just took the week off for the holidays. On the 28th, we received $3,000 from Gomez on its receivable. And if you look over here, you see that we reflected cash coming in and accounts receivable going down. So now, if you remember, and I hesitate to do this because it always seems like it's hard to get back to it. Here was that original receivable. We billed them $5,208, of which they paid $2,208, so they still owed us $3,000. And that's what's happening in this particular entry. That's what happens in this particular entry. We're getting the cash in, and the receivable is going down. Okay, reimbursed S-ray for business automobile mileage 600 miles at 32 cents a mile. And when you work through that calculation, what you get is $192. So 32 times 600 is 192. And so that's your mileage expense. And it's the same thing we did in November and December. So what you'll notice is that these things keep repeating themselves. So once you have an understanding of how it works the first time, it's always going to repeat itself time after time after time. Okay, last one before we do our adjustments. S-Ray withdrew $1,500 cash from the company for personal use. And this is the same thing that we did in October and November. Withdrawals are part of equity. They are part of equity that make equity come down. We still have to track them. And that's why we continue to accumulate all of these. And so again, let me just pop over here to the notice that we have here 3,600 and 2,000. So we're tracking these withdrawals so that we can properly account for them for tax purposes. And that's what we'll do with this one as well. And every time we do this withdrawal, it brings equity down. Equity is on the right-hand side of the equation, and therefore equity, that is what is left, what our ownership portion of the business is, goes up on the right-hand side. It goes down on the left. So if we take things out of the business, then it should make sense that we are By doing that, we are reducing the value of the business. Okay, so what I'm going to do now is I'm going to go back and I'm going to post these entries to the ledger. And by the way, I'll send you all of these spreadsheets so you can see them if you want to take a look and see exactly what's happening there. But I'm going to stop this video at this point because I'm going to then post this stuff so that it doesn't take our time up doing it. And then we will start with a new trial balance at the end of December before adjusting entries. So thanks for your attention, and we'll see you the next time around.